Hi everybody, welcome to the channel. Welcome to all the new subscribers. My name is Jake and I share my journey to financial freedom here on YouTube. I'm a dividend investor, and if you clicked on this video, you're probably interested in dividends or investing into dividends. My videos are really tailored around newer or beginner investors. Really, I'm kind of talking, if I were able to, talking to my younger self and kind of sharing bits and pieces of what I've learned along the way as I've started investing in a dividend growth strategy. And in today's video, I want to talk about economic moats. I've seen over the last couple of weeks and even months here on YouTube, there's been so many investing videos around the topic of, is there going to be a recession in 2020? Is there not? There's so many things going on with the trade war, now with Iran. There's so many things going on. And what I try to do in my videos here is really stick to the basics. And in today's video, I'm going to talk about 4 different things. I'm going to talk about what is an economic moat, very generally, very basic. The next thing that I want to talk about is why is an economic moat important? The third thing is how you as a newer or beginner investor looking to invest in a dividend growth strategy, 3 ways that you can identify if a company has a sustainable economic moat. And then the 4th thing that I want to talk about is 3 companies that I currently invest in with a sustainable economic moat, and share how I do that in M1 Finance. And I'm going to timestamp all 4 of these, so if you're just interested in the one, you can skip ahead to the topic that interests you most. All right, so to begin with, what is an economic moat? An economic moat is, if you think back in medieval times, where you would have a group of people, no matter what time frame. I used to live in Germany, and if you were ever to go on the Rhine River and you look left and right, you would see a castle on every side. But a castle, it's protecting, whether it be its people, its economic resources, whatever it may be, it's a protection from the outside world. That is what the castle is there for. And then the moat is that extra area, that extra protection from the outside. So that's kind of what a moat is in layman terms. An economic moat would be relative, for example, for a company. In capitalism, companies are constantly under attack, and they have to maintain that competitive advantage. Now, the theme here is really keeping a competitive advantage. When you think of economic moat, think of competitive advantage. Now, I want to skip ahead here for a second, and I want to hear directly from Warren Buffett how he defines what an economic moat is.
What we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle.
All right, so that is what an economic moat is, according to Warren Buffett, one of the greatest investors of all time. Now, moving on, why is an economic moat important? Now, if I look back in the last decade, there's been so many iconic brands that we used to love and use every single day that are no longer around today. Let me just name a few. Just off the top of my head, for example, Blockbuster. Blockbuster, everybody here in the United States that grew up in the 90s, the 80s, and beyond knows Blockbuster. They no longer exist. Netflix came in and absolutely made them irrelevant. Nobody saw it coming at the time, but looking back, it's like, well, okay, yeah, of course. Blockbuster should have done X, Y, and Z, but they didn't. Another example is your classic brick and mortar retailer, whether it be Sears, whether it be Circuit City, and so forth. These retailers, they were slow to adapt, slow to innovate. Another example, Kodak. I remember traveling back in the early 2000s, going to Germany and taking my Kodak camera with me everywhere and taking a picture, right? And as this digitalization came up and as everything transitioned to digital, Kodak did not adapt, and today they no longer exist. When was the last time you heard about Kodak? So this is why an economic moat is so important. Companies that were great, today or yesterday does not mean that they're going to be great tomorrow and in the future. So that is why an economic moat is so important. Okay, now I want to hear from Warren Buffett directly why he feels, or why does he believe an economic moat is so important.
All moats are subject to attack in a capitalistic system, so everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. And what we have to decide, and most moats aren't worth a damn in capitalism. I mean, that's the nature of it, and it's a constructive thing that that's the case. But we are trying to figure out why is that castle still standing?
All right, so why is an economic so important? It's important to keep that sustainable growth, to keep that sustainable competitive advantage. I think that's what's so important. As a dividend investor, our livelihood, our passive income is reliant on our dividends, the cash flow. And if companies are not continually paying out their dividends, maintaining their competitive advantage, growing their business model, growing their economy of scale, and growing their dividend, the concept of dividend growth investing does not work. And that is why it is so important. All right, now I want to go to the third point here that I wanted to talk about is how you as a newer or beginner investor can identify if a company has a sustainable economic moat. There is so much academic research, there's so many things out there on the internet, and I just want to simplify it as a new investor or a retail investor, how you can go about and know fairly quickly, okay, is this company that I'm investing in, does this company have an economic moat? Or are they going to be a Blockbuster or a Kodak in the future? Okay, and one thing that I don't share a lot of economic or I guess theoretical pieces of information on my channel, but one thing that I do want to share is one piece from the Porter's 5 Forces. If you're a business graduate and you took any economic classes or marketing classes, this may have been a topic. Porter's 5 Forces, it's really the environment of competition that a company faces. And these are the 5 forces that pretty much every company is facing. Threat of new entrants. So for example, Blockbuster, they were the king. Back in the 90s, nobody could touch them. But then here with this digitalization with Netflix, they were a new entrant, and then they took market share and they took over. Another example could be supplier power, customer power, threats of substitution, so an alternative source of a product that a company offers, something different or something comparable, and then the degree of the overall competition. One area of this that I think a lot of people can understand is retail. There are a lot of retail stores. Walmart, Target, Costco, there's Amazon, there's so much competition in the retail space. All right, so that would be a few examples. Now, I want to shift over here to the Morningstar description of the economic moat, and I'll leave a description a link in the description to this page right here, if you want to check it out yourself. So the 5 sources of sustainable competitive advantage, according to Morningstar, are the following: intangible assets, right here, switching costs, network effect, cost advantages, and efficient scale. All right, and it shows here a few examples of a wide moat, a narrow moat, or no moat. A wide moat is, I guess, the depth of the moat. If we go back here and we look at the picture here, how wide is that moat? Is it a big moat? Do they have a really big moat? The bigger the moat, the wider the competitive advantage the company has. If it just has a small moat, like a small little sliver of water, that's not a very wide moat. Okay, so and this is how Morningstar categorizes them. All right, a few examples of a wide moat would be, for example, Coca-Cola. Coca-Cola has intangible assets. They pretty much check off every single box here. An example of a company that doesn't have a wide moat in a similar sector, it could be, for example, Jones Soda. If you're familiar with Jones Soda, Monster is a big brand, but I don't think they have a wide moat. The switching costs, for example, from Monster to Red Bull or another, or if Coca-Cola comes out with an energy drink, I think Coca-Cola is going to win that battle. Okay, now to really simplify it, now the three ways that I use as a retail investor to identify if a company has a sustainable moat, I've really summarized it into three categories. The first one is switching costs. As a consumer, how easy is it for me to switch? Now, if I'm investing into consumer brands, for example, if I go over to my consumer staples slices, some of these brands that I'm investing in Coca-Cola, Kellogg's, Procter & Gamble. How easy is it for me to switch into another product, right? And so that's kind of something you want to think about. When it gets into a larger scale, into, for example, a business-to-business setup here, it's a little bit more complicated. But that's really how I start is, okay, well, what are the switching costs? How easily can I switch? The second thing is economy of scale. How big is this company? Is this company, are they well established? Do they have a good brand? Do I know this company? For example, Apple. Is Apple going to be replaced tomorrow? Are they available in different parts of the world? Like, those are the type of things that I'm thinking about when I'm investing in companies that I believe have a wide moat. All right. So the first, switching costs. Second, economy of scale. And then the third thing is going to be, for me, innovation and disruption. Is another company going to come in and render my product or this company that I'm invested in obsolete? For example, Blockbuster and Netflix. Is another company going to come in and tomorrow is my company going to be gone? For example, is another company going to come in and make Costco irrelevant, or Kellogg's? We can take another look here at another slice that I have. Let's go into industrials. Is there going to be a company tomorrow that's going to come in, or in the future, maybe in a year or in 10 years, that it's going to make 3M obsolete? I don't think so. Another example is waste management. Is a company going to come in, is somebody going to innovate something and disrupt the waste management industry? I don't personally believe so. I'm sure that there's going to be innovations, but I don't think it's going to render waste management obsolete. So those are the three things that I, as a retail or dividend investor, look at when I'm investing into companies. That's a big reason when I'm investing into the technology sector. I can show you here. I'm very cautious of what companies I invest in the technology sector. That is a big reason why I don't invest into video game stocks. I love playing. My classic WoW and League of Legends. I play that and sometimes in my free time. But I wouldn't, as a dividend investor, I don't invest into those companies because they're so easily disrupted. For example, with EA and Blizzard Entertainment, those were the kings, right? And they still are, in my opinion. But with the entrant of Fortnite, it just totally disrupted the market. And it's so easily done, and that is why, for me, it's difficult for me to invest into a company like that where that could happen at any time. However, with Apple, with Visa, with Microsoft, I don't believe that these companies are going to be at risk due to innovation or disruption. They are the disruptors. They are the innovators, in my opinion. All right? So those are the three ways that I identify if a company has a sustainable economic moat, right, as a dividend investor. Okay, now moving on to the last point that I want to talk about in this video are three companies that I invest in with a sustainable economic moat, right? And as we're in the technology sector right here, I do want to talk about the first one being Apple. When I was in college and there was a survey done with the entire group, I think there was like 100 people in this massive auditorium, and there was different computer models placed on the screen with their different specifications, how much RAM they had, what was the speed, et cetera, et cetera. And the majority of the computers had much superior specifications than Apple, I think there was 5 different computers. But every single time, Apple shined. The Apple Mac beat every single other computer. I don't know if it was a fluke or what it was, but Apple had that brand recognition. Even though there were other computers that were inferior, or superior to the MacBook that was on display there, the majority of people in the auditorium selected the MacBook. That's brand recognition. And that, for me, it really opened my eyes that, okay, all right, Apple has got something going for it. Right? And that is a company that I think, not just because it's seen a massive uptick in its stock price in 2019, but just overall, I think it's a great company with a wide economic moat. The next one that I want to jump into is in my consumer staples slice here in M1 Finance is Coca-Cola. Coca-Cola is my favorite consumer staple stock. It is the one that I have set at the highest target allocation. This is a way that, while using M1 Finance, this is how I diversify based off of economic moats, I guess you could say, for that matter. I believe that the Coca-Cola over the long term is going to maintain that wide economic moat, and therefore I'm going to have it at a much higher target allocation compared to the other holdings in my consumer staples slice, right? So Coca-Cola is going to be my second company with a wide economic moat. The third one that I'm going to share with everybody here in this video is going to be in my consumer discretionary slice. And the third one is going to be none other than Disney. My wife and I, we just saw the last Star Wars here yesterday. I think can hear everybody's thoughts on how they thought the movie was. I personally thought it was great. Just my opinion. I think it was a really good movie. But Disney is my third pick that I'm investing in that I believe has a strong, sustainable economic moat. All right, and you can see how I've set it up here. I think McDonald's is a close second, and and Nike and for example. But for me, I believe Disney is going to shine over the long term, and that is why I have it set. I have my target allocation set at 30%, higher than the others. All right, okay. So everybody, those are the 3 stocks or 3 companies that I invest in that I believe have a strong, wide economic moat. Let me know in the comment sections if you agree, if you disagree, if you would add anything. I'm sure there's many others that we could add that we're not going to talk about on this video, but just to keep it simple, let me know in the comment sections what you think are other great companies that you invest in that have a strong, sustainable economic moat, and why. All right, and so in the now moving on, I think what I want to talk about here for the last couple of minutes of the video is give everybody a quick update on where I'm at in the portfolio. As you can see here, there's been a little bit of a dip since my last video, and this dip here is artificial. One of the holdings that I have in my pie is going under a rename, so it's taken out of the portfolio temporarily and then will be placed back into it under a different name. But it shows as if the funds are gone. I had to talk to the M1 support about that. But very simple. Once the rename has been issued, it'll then re-show. It should be showing by my next video. But the overall gain is a little over $2,000. Of that, $500 has been in earned dividends. That is what I'm looking for. As a dividend growth investor, I'm really looking for the earned dividends. The market capitalization, it's kind of that cherry on the top, but that's not really what I'm looking for. Over the last couple of weeks, the amount of dividends that have been coming in, they've been very minimal. However, every single cent counts. Every single cent impacts the compounding effect, right? Walmart, I have a very small position in Walmart in the moment. Only 5 cents. Nike as well, just 49 cents. Travelers Company, a little over $2. Union Pacific. And the cool thing about M1 Finance compared to other portfolios, when you think of a drip, where it's automatically, the company that you're getting the dividend from is automatically reinvested into the same company. How it works with M1 Finance is all of the dividends that I'm getting from these different companies are being reinvested into my overall portfolio. So that means if I got a dividend from Wells Fargo, it would then reinvest into other areas of my portfolio based off of my target allocation. And the target allocation, this is the powerful thing about M1 Finance that really makes it so you can put it on autopilot, is you set your target allocation. It's very, very simple. You can set it. I have individual companies within my individual slices in the pie. You can see here the entire pie. And if I wanted to say, okay, let's say we had a major event happen. I know with Iran, there's a lot of things, a lot of uncertainty going on, and this is going to really impact the market. If we were to say, okay, well, tomorrow we're going to be hit with a massive market correction, you could then go in and then you can make an adjustment. You can say, all right, well, I want to up my utilities because historically they've been a lot more stable in market corrections, whatever it may be. And then you can go in and then you can adjust the target allocation, and you've done that once, you save it, and then what M1 Finance does is that it's on autopilot. Then everything that you invest, if you invest it daily, weekly, or just your dividends, they will then be automatically invested, and I can show everybody, into your underweight holdings. And you can see here, for example, $50 were transferred over on December 30th. I also received dividends from Union Pacific and T. Rowe, which purchased $51.68 and purchased the following companies. Right? And that's how M1 Finance works, and I absolutely love it. I also use Robinhood, and I think Robinhood is great if I want to make a purchase at a specific price and I want to be a little bit more hands-on. But if you want to set it on autopilot, I think M1 Finance is a far superior platform, in my opinion, though I do use both. Speaking of Robinhood and M1 Finance. And then typically I keep the auto invest on. What that means is every time there's $10 or more in my portfolio, it will then automatically invest every single day. And I currently have the auto invest off, just in case you're curious. Most people, this is not applicable. I currently have it off the last couple of days because one of my REIT holdings is going under that name transfer. And if I were to put the auto invest on, it would then transfer all into the old holding. And I don't want to do that. So I'm going to wait until that transfer finishes. And so this is how I have it set up. The majority of my qualified dividends, so all my US-based companies and ETFs are in this portfolio. And I do have a sub-account within M1 Finance. This is another cool thing, is you can have multiple sub-accounts. Say, for example, you want to save for a specific event in your life. Say you want to save for a home, or you have a kid and you want to save for their college education. You can set up a separate account within M1 Finance, and without having a different login or different paperwork that you have to fill out, you can have multiple accounts for different goals in your life. For example, if you wanted to save for a vacation, or you wanted to save for a new car, whatever it may be, or you want to save, in my case, for early retirement, this is the account that I have for that. In my real estate account, I've talked about this account in previous videos. I'm not going to go into it here. It is set up very similar as my other account, with the different sectors within real estate investment trusts. All right, everybody. So that is the portfolio. Today we talked about economic moats. I hope that this was helpful. Really, I try to keep it as basic and straightforward as I possibly could. If this was helpful and you want to see other such videos like this around dividend growth investing, I'd invite you to subscribe. If this was helpful to you, I would ask you to please hit the like button. It helps with the YouTube algorithm. And everybody, I will catch you all in the next video.